Andrew, welcome back to the show. How you doing, man?
Good, good. How are you? I'm glad to be back. I know we've done this a few times already,
Yeah, for
and
sure.
just trying to spread the tax love and knowledge a little bit.
There you go. Well, cool. I got a couple talking points for our show today. This will probably
Right?
air 4 weeks after we record this, 5 weeks after we record this, so it'll be somewhat timely. So here's the first
Yep.
question I have for you, and it's this. So a lot of people, when they flip properties, there's two ways that they'll report their income. They'll either report their total sale of the house, let's say 500,000, and then they'll take their purchase price and their renovation and all their soft costs, and then the difference will be the profit, right? Which is one way to do it. So you have the revenue and then the cost of goods. The other way that people do it is they'll just report whatever they net. Like, let's say they net 40 grand. Instead of saying they sold the house for 500 and their cost of goods was 460, they'll just say, hey, I made $40,000 on this, and that was my income. So what is your thoughts on how to do that? Was there a better way to do it than the other? And what's your thoughts on that?
I don't know that there's necessarily a better way. I, for one, usually start with the net profit, personally. Um, but it does depend on how the deal is reported and what kind of deal it is a little bit also. For example, if there's going to be a 1099-S um, generated for the sale of the house, which sometimes there are by the attorneys, and that's basically a form that's reported to the IRS, then we at that point we need to report the full sale price of the house and the expenses.
Got it.
If there's no 1099-S generated, I don't see the harm in just starting with the profit and
Got
going
it.
from there. As long as you properly break it down, we're keeping track of all you have to keep track of the sale price, the purchase price, and all that kind of stuff to
Yeah.
get to your net profit. And as long as we could all sort that out properly, I'm usually good just starting with the profit and going from there.
Yeah. So just recording the 40 grand and then just keeping it that way versus having like the purchase price and you got all the closing costs, settlement statement, this, that. It just because it becomes an accounting, pain in the ass for the most part.
Yep. No, no need to get too complicated unless we have to.
Yeah, for sure.
I think.
So yeah, because there's like two schools of thought to do it. And I know people who do part A or theory A, and I know people who do theory B. So it's always interesting to see, like, it's really the same thing. It's like, how are you going to get there, right? So that's a good starting point. So if you're flipping properties, definitely figure out if your title company or attorney is reporting that, because it's some do and some don't. It really depends. I know
Yes,
California is
that's
pretty
very important to know.
yeah.
It's very important to know if that 1099-S is going to be generated for the government. And I only say that because we're reporting the profit either way. So it's not
Yes.
like we're not trying to dodge things here. That's not the point. Your income has to be fully reported, no dodging. There's, especially in real estate, there's plenty of I don't know if I want to call them loopholes or strategies or whatever we want to call them to reduce your taxable income, that there's really no need to try to dodge your income.
Yeah, because
You know
there's
what I'm
so many
saying?
ways you can offset it with expenses. So why try to
So many,
screw
so
around?
many.
Yeah. Well, that brings
No,
me to my second
there's
point.
so many good.
Yeah, so many good ones. So here's another thing I hear a lot. I want to pay less in taxes. Like, how do I get my tax bill to X? Right. And usually the only way to do that is, well, you have to legitimately have the amount of expenses that you're saying. Therefore, you will only
Yep,
pay taxes on the difference. However,
yep,
a lot of people, including myself, do the cost segregation study, which is basically a way to like take a lot of depreciation up front so you can have less tax liability that certain year you
yep,
obviously took the depreciation and purchased the
yep.
property. So really at the end of the day, like, when do you recommend someone does the cost segs? Because some people it really doesn't make sense to do, and other people it really kind of it does benefit them.
So there's a few things to think about here. First of all, the size of the property will get you uh, will kind of depend on if a cost seg makes sense or not, right? The cost of the property, the amount of units, the the smaller the property, the smaller the cost, the less benefit you'll get from doing the cost seg study. Because you have to remember they're time consuming a little bit. They're a little costly because even if you're doing one of those DIY cost seg studies, it's still probably at least $1,000 or $2,000 to do it. So you have to be saving some money, right?
Yeah.
The big 50, 100 unit apartment buildings will have a lot more benefit than a single or a duplex or a quad, right?
Yeah.
So generally speaking, higher purchase price, more stuff to segregate there. So that's number one. Number two, to be able to fully take advantage of your real estate losses, you either have to be, you or your spouse, if you're married, have to be a real estate professional by the IRS definition, 750 hours a year, no less than any other thing else you're doing. So probably tough if you have a W-2 job,
Very tough.
or other businesses or anything like that, right? And there's really a couple ways to get some good depreciation, either um, either through syndicates, go into syndicates because they're often doing the cost seg studies, or doing the cost segregation studies yourself on your properties.
Yeah, just doing it. I do the DIY ones because they're not big properties, and it saved. I mean, it saved me a bunch of money last year. Like it was where like I ran the numbers.
No. Yeah, for you it definitely makes sense. For other people in your position, it definitely makes sense. Just before you do them, consult your tax professional to see if they really will help you.
Yeah.
Paying your tax pro a few extra bucks for a consultation could save you money and headaches in the future.
Yeah, for sure.
For sure.
For sure. So that's because if you think about it, you buy a rental, let's say that rental gives you like $3,000 a year of depreciation if you did the straight normal way to do it.
Yep.
But if you could turn that $3,000 into $12,000 the first
50.
year,
yeah,
that's $12,000 you're not paying in taxes. And if it costs you $2,000 to save 12, I mean that's a really good 10. That's a 10-to-1 return on whatever you spent.
Yes, as long as you qualify to take your real estate losses.
Yes, you have to be the real estate professional, or else it's a waste of time.
Yes,
basically.
If you and your spouse both have W-2 jobs making a couple $100,000 a year, it's not likely a good strategy for you.
Yeah, that makes sense. No, that makes
at least one of you has to be considered a real estate professional according not your own definition, but the IRS definition.
Yeah, that's true. So on that note, now this is obviously like, who knows, but there's this thing out there where they're like the IRS hired like 80,000 new agents. Like, do you think it's going to be easier to get audited now, or is that just the news media trying to get people on their toes?
I think part of it is just people getting riled up for not too much.
Yeah.
First of all, the 87,000 people is over like a 10-year period or something like that. They didn't hire 87,000 people like last month. It's over 10 years. And they're extremely understaffed already. And that's if they could find 87,000 qualified people to hire, right? It's not like there's just 87,000 people that are qualified to work for the IRS sitting around doing nothing right now.
Yeah, you have to poach and you have to recruit and you have to get someone who's good, like maybe a tax person who, you know what I mean, an attorney. Like, yeah, it's not like you just, hey, Joe, you like numbers? Why don't you work for the IRS and hose up?
Yeah, no. Do I think at the end of this, the audit risk might go up minimally? Maybe minimally, but it's so low right now. I don't see them actually hiring 87,000 people just because I think there's a shortage of people to hire as it is. And I don't think they were all auditors anyway. I think a lot of them were doing back office and technology type stuff. So it wasn't even like it was 87,000 auditors.
Yeah.
And also, that being said, they've been blowing out of proportion that a lot of them are going to be like carrying guns and stuff like that. There is not going to be an IRS agent showing up at your door with a gun drawn unless you were working for like Al Capone or El Chapo or something like that. if you're 1 year behind on your taxes and owe a couple grand, nobody's coming to your house with guns drawn, trying to collect that money or anything like that.
Yeah. No,
Please
that
calm
makes sense.
down. Be realistic. That is not happening. Are they going to try to hire more agents? Yes. Is it going to be as bad as some people are making it out to be? I highly, highly doubt it. I
Yeah,
highly doubt it.
I agree. All right. Now, on that note, you've seen a lot. You've been doing this for a while.
Yep.
If someone wanted to get audited, what is the top 2 ways to have the probability of you getting audited be there?
Leave stuff off of your return that is clearly reported to the government. W-2s, 1099s, the 1099-Ss we brought up before. Any reporting documents that the IRS has, report that. You have to be reporting all of your income anyway, but the quickest way for the IRS to know something is to leave off one of the documents that they have, right?
If they know you did X and you didn't put X in the system, they're like, well, what about
You're
this
getting
thing?
a letter. You're getting a letter for sure. And look, this is not me condoning leaving off cash income on your return. All income is reportable. Just remember that. That being said, it's harder for them to know about the cash income unless you get audited than it is the income that they already know about. But make sure you're reporting all your income on the return, and don't get crazy with your expenses, right? They have to be they are what they are, and they should be defendable. But there are thresholds that would probably cause the IRS to want to take a second look. For example, I've always heard that anyone reporting more than like 10 or more % of their income as charitable contributions risk getting a notice or an audit. Now, I'm not saying that those people are incorrectly reporting their charity. They may 100% be reporting it correctly.
Yeah.
That being said, that things like that could bring about a notice.
Yeah, that makes
And
sense.
also, on top of that, high earning businesses, bigger businesses, high earning individuals tend to get audited pretty frequently. Some of the top earners that like the IRS might have a field office in Amazon's headquarters and Starbucks, and there's auditors that just deal with making sure everything is properly reported with these big corporations, high income earners, stuff like that. Probably have a better chance of getting audited than the smaller income earners.
The smaller business owner, the guy making, I see what you're saying.
Yeah.
Okay, so that's the thing. Now, go ahead.
That being said, the risk of an audit is not a good reason to change up your reporting. You're still supposed to report properly your income, your expenses, and things like that. We're discussing what might be the risk of hearing from the IRS.
Yeah, that makes sense. So on that note, I know you got to go in a couple minutes. So when it comes to this thing, I see a lot of people online, they're talking about like, instead of paying taxes, they're going to go buy a freaking Cadillac Escalade or something. Can you explain the theory behind that? Because I don't understand that. And if I could pay 60 grand to the government or go buy a freaking Range Rover in cash, I'm going to do that. Like, what is the whole deal with that?
Yeah. So keep in mind that the depreciation for vehicles is different than normal depreciation. That being said, if you buy a 6,000 pound vehicle that's used strictly for business, and there has to be a good reason for this, but if you're buying a 6,000 pound plus vehicle used strictly for business, you could take accelerated depreciation on that and save a lot of money up front. That being said, I only suggest doing that if you're really in the market for a new vehicle anyway. And I say that because if you buy a $50,000 vehicle, right, you're not saving $50,000 in tax. You're saving $50,000 in income. which is likely going to save you like anywhere between 12.5 and 20,000 in tax.
So you're really getting the
they're
vehicle at a
not.
discount.
Yes, yes. The government is not reimbursing you for the car through a tax refund. You're just knocking that off of your income.
Yeah, you're
And it
knocking the
has to
50
be
off of your
business.
income. I see what you're saying. Yeah, you're knocking
Yeah.
the 50 off the income.
And listen, it has to make sense. You have to use it for business. Do not believe every word on TikTok is pertinent to your specific situation. I'm happy that my clients know tax ideas, but it is much easier for us to deal with things ahead of time than it is afterwards.
Oh yeah, for sure. Especially
So,
when they don't have the right information. They're thinking like, oh
yes,
yeah, I'm gonna save 50 grand in taxes. It's like, no, you'll save
no,
like 20. So if you're in the
maybe.
market to get a car and you want to save 20 grand on the car, in theory, yeah, that makes sense. But if you're just thinking it's gonna wash out your tax balance, it's probably not the case.
No, no. It's
Unless
not a dollar for dollar.
it's not a dollar for unless like at the end of the day, like let's say you did $1 million in revenue, $950 in expenses, and you have a $50,000 like, you know, kind of quote unquote profit income. If you took that 50 grand and bought the car, you would get your taxes lowered a little bit, right?
Well, yes, you're getting your taxes lowered.
Yeah.
But you're not getting a $50,000 deduction in your tax. Like you're trying to say, you're getting a $50,000 deduction in your income.
Yes.
Income, not your tax. And for that $50,000 deduction in income, you're saving, let's call it probably 7,500 to 20 grand, depending upon your tax rates and everything like that.
So here's this question though. So let's say that happens. So let's say someone does $1 million in revenue, $950 in expenses. Their final expense for the year was a $50,000 Cadillac Escalade. Okay. Now their P&L shows a zero.
That could be. Yep.
They're not paying taxes, right?
Could be.
It depends. That's where it's like,
it depends on your specific situation, but that scenario can definitely be true.
Yeah. You could in theory say, oh, well, the company broke even. This car was a business expense. I didn't show any income. But the thing is, even when you do that, then it's harder to get a loan. It's harder to borrow money because on paper, you're not making money, even though you might have taken dividends out or whatever. But it's a slippery slope. Sometimes you do want to show an income because if you show a high income, you can buy more real estate versus if you've been netting your income out and zeroing it out for 5 years, you could have been, doing a lot of revenue. But if the bank sees for 5 years, you've like gotten a refund from the government, they're like, well, the guy looks good. He drives a nice car, but he doesn't make any money on paper. And then it's hard to get a mortgage, right? So it's like kind of like a double-edged sword.
That's the realistic side of things there. There's the tax side of things, and then there's the realistic business side of things also.
Yeah.
And it usually doesn't make sense to run your business to save taxes. It makes sense to run your business to make a profit.
Yes.
Then we do after that, or maybe not even profit, but let's call it cash flow.
Yes.
The purpose of your running your business is to make cash flow.
Yes.
After that, then we discuss how we could save you in taxes.
Yes. That's the way to go.
Ask us questions, get in touch with your accountant. Don't do anything crazy before talking to your accountant. That being said, your business decisions should be cash flow motivated and not tax savings motivated, because the tax savings motivation is just a small piece.
It's just a small piece. You should be paying as much as you need to, not zero. Because if your goal is to buy more properties via financing and you're optimizing for tax savings, you're not going to have a good chance of buying those properties because no one's going to give you a loan if they're going off of your income, right? If you're buying a DSCR loan, it's different. But yeah, there's just so many things with taxes that people have questions about. So I think we covered a lot of pillars today on the podcast. So Andrew, I mean, if people are, I mean, do you do stuff only in the Northeast or you deal with clients out of state?
No, I have clients all over the country. Most of my clients, I would say, are in the Northeast, New York, New Jersey, Connecticut area, Pennsylvania. That being said, I have clients in different states throughout the country. So if you have a situation that you think you need help on, I can probably help you. And if I can't help you, I probably know who can help you.
That's awesome. So if people want to get in touch with you, how do they get in touch with you?
My website is www.andrew-cpa.com.
Okay.
My number is 973-879-9111. And my email address is akabatchnick@gmail.com. Hopefully my name will be linked here with the podcast so that you can
it'll
spell
be in
my
the
last
notes.
name.
It'll be in the notes.
It's my first initial and last name @gmail.com. You could easily reach out to me. And if you can't find a way to get in touch with me, reach out to Greg. He knows where to find me.
Exactly.
Perfect. So we're here to help. That's the goal. I just wanted to give you a couple little tidbits to get your mind racing and knowing that taxes are important. The tax perspective shouldn't be making your decision for you necessarily, but they're very important to consider.
100%. Andrew-CPA.com. That's the best. That's an easy peasy domain name. Andrew-CPA.com. We'll put all that stuff in the show notes. Andrew, I appreciate you taking the 20 minutes out to chat with us today, and we'll talk with you soon.
All right. Have fun, everybody. Take care.